Respected viewers, my name is Talal Ahmed, and I'll be presenting my analysis on the ExxonMobil merger and try and highlight the key participants, motivations, valuation techniques and utilized, and finally any defenses or strategies adopted by the respective companies. Moving on to slide 2. Exxon and Mobil, two of the America's largest oil companies, declared the intention to merge on December 1st, 1998. The bidder, Exxon, publicized its decision to acquire the target firm Mobil Corp for nearly $76.2 billion in stock. It was reported to be the biggest ever agreement in the history of the oil and gas industry, surpassing British Petroleum's takeover of Amoco for $49 billion in stock. Exxon was striving to achieve a stronger presence in the parts of the world which had the greatest scope for oil and gas discoveries and extraction. Merging with Mobil made sense because it gave rise to the potential of achieving that presence. As by combining the complementary assets, the company would be in a significant spot to finance heavily in programs which had the potential of high risks and returns. Operating synergies was one of Exxon's prime motivations, and a $2.8 billion operational synergy was predicted. 66% of that operational synergy was expected just simply due to the eradication of duplicate operations and facilities. General and administrative costs were predicted by Exxon's management to be reduced, which would free up funds to invest in different regimes. However, the prediction was surpassed entirely as ExxonMobil, in a news statement released 2 months after the merger, that the synergy was about to reach $4.6 billion. Moving on to slide 3 and 4. Timeline and the critical events which final nitty-gritties needed to be formalized first, of course. In fact, Mobil welcomed the merger request and the transition was as smooth as it could be. However, there are regulatory bodies involved, for example, the Federal Trade Commission, which partnered with the European Commission, spotted that the merger would weaken the competition in the refinery market and would enable the synergies required to increase oil prices for consumers. Exxon and Mobil therefore had to come up with a remedy and jointly propose the divestiture of the distribution lines, including the sale of nearly 2,400 gas stations in various parts. Exxon paid 1.3 shares per share of Mobil and ultimately purchased 1,030 million shares for a $72 per share price, which overall amounted to a figure of $74.2 billion. This indicates a $15.5 billion or a 26.4% premium paid over Mobil's market valuation. Slide 5 to 8 will be discussing and focusing on the valuations of the merger and our estimates of the merger. Considering Mobil individually was a mature company, the constant growth model of the cash flow valuation will be utilized to determine the value of the firm. As referred to in the slide, this is conducted by taking the operating free cash flow and dividing and discounting it by the WACC, which is the weighted average cost of capital, and subtracting it by the long-term constant growth rate. However, to obtain the discount factors of WACC and growth, some formulations need to be done prior, and we'll be utilizing CAPM for that. Cost of equity, which the formula for CAPM is cost of equity equals risk-free rate plus equity risk premium times systematic risk, which in other words is also called beta. Mobil's beta was calculated as 0.75. However, there is always a tendency for estimation error for oil companies. Could be more, could be less. The risk-free rate is taken at 5.6%, which is measured by estimated yields on 10-year treasury bonds. The equity risk premium is taken as 4.5% for Mobil, and researchers and consultants have opted for using a 4 to 5% market price of risk. The cost of debt can be calculated on the method utilized by Kaplan in 1995, as he explained how bond ratings and yield data are potentially market-based. Therefore, Mobil had a bond rating of AA, which resulted in a cost of debt of 7.5%. The market value of Mobil's debt and equity proportions, which is going to be utilized in calculating the WACC, are 30 and 70%. Respectively, 70% being the equity and 30% being debt proportion. The corporate tax rate is simply calculated at 40%. In order to derive the WACC, the market value of Mobil's equity will be divided by the total market value of Mobil's financing. The resultant figure is multiplied by the cost of equity. Additionally, the market value of Mobil's debt will also be divided by the total market value of Mobil's financing, and the resulting figure is multiplied by the cost of debt. Lastly, the overall figure is multiplied by 1 minus the corporate tax rate. Simplistically, the formula is mentioned in the slide, which gives us the WACC percentage of 7.5%. The constant growth rate is estimated to be 5.5%, and the free cash flow for Mobil in 1998 was $714 million. This was extracted by the annual report for Mobil Corp in 1998. Altogether, the aforementioned values give us the firm value of $34 million. Slide 9 to 11 will be focusing on the relative valuation method. The relative valuation method is a method that compares a company's value to that of its industry to estimate the firm's worth altogether. Now, to determine the firm's value, there are several valuation multiples that can be opted. However, in regard to Mobil, we'll be utilizing the price to earnings ratio of comparable companies, and which will be further multiplied by the after-tax earnings of Mobil in 1998. Simplistically, the formula is mentioned in the slide, which gives us the firm value of 189.14 million. Slide 12 to 15 will be focusing on cumulative abnormal returns, which in short is called CAR. Abnormal return reflects the unforeseen profits generated by the particular portfolio over time. Cumulative abnormal returns is achieved by adding all abnormal returns during the respective time, minus a few days, plus a few days. CAR is used to just simply measure the effect on stock prices due to significant events, for example, merger announcement. The subsequent market returns were calculated using the formula ending stock returns subtracted by the starting stock return divided by the initial starting stock return. The intercept and beta are derived by using the respective stock and market returns. The expected returns are found by adding the intercept and beta and multiplying it by the market return of that particular day. Abnormal returns are found by subtracting stock return percentage with its respective expected return. Lastly, the CAR, or cumulative abnormal return, was found to be 0.182. That is derived by adding all the abnormal returns, which can be seen from the Excel book mentioned on slide 15. Now, efficient market hypothesis indicates that share prices have the tendency to reflect all possible information, and there's no tendency for information asymmetry. The stock price and their respective market returns would be correct, then there's no possibility for an investor to purchase undervalued stocks or even sell overvalued stocks. ExxonMobil merger was scheduled to bring synergy worth millions. However, the stock return that we've calculated indicates a negative return, which reflects depreciating value. Therefore, this negates the notion of the efficient market hypothesis and would only indicate relevancy if the stock return would be positively increased, and that too significantly. Lastly, we'll be concluding. There was minimal conflict over leadership style, authority, cultural stability, and operational integration. Therefore, ExxonMobil was a rare merger that bore fruit not just for the shareholders, but for many stakeholders. Thank you for listening.